We think all those people are doing an amazing job, and we really wanted to showcase what's in the market, what could be classified as a success, as a failure, as a lesson learned. And for all these reasons, we are super happy that we have everyone today. So maybe we will start by introducing ourselves. I'm leading all the advisory and ecosystem activities of INP. My name is Marianne. And I've been working on this report with three people. Aissatou, who is joining me today to co-host this webinar, but also Hugues and Julie, that I want to thank for their amazing support as well. Aissatou, do you want to maybe introduce yourself, and then we can talk about our famous guests
Yeah,
that
sure.
will be the speaker today.
Sure. Thank you, Marianne. Good evening, everyone. My name is Aissatou. I am an investment manager at INP, and I work on the fund activities of the company. And I had the pleasure to work on this report alongside the team. Thank you for being here with us today.
Anzi, I don't know who wants to start.
Z is an LP, so she gets to go first.
And I definitely think you should go first in that case.
That's fired. No, go on.
All right.
Today,
yes. Good evening. Good afternoon, everyone. Nice to meet you. My name is Anne Juki, and I'm founder and managing director of Sayuni Capital. Sayuni invests debt in profitable SMEs that are run by women and local entrepreneurs. We are starting off by investing working capital facilities of $250,000 to $500,000 to SMEs in Kenya and Tanzania that are in the consumer goods value chain. And so we define that as everything from light manufacturing, agribusiness, distribution and logistics, and trade. By way of background, I started off my career as an operator, as an engineer, then joined McKinsey, doing management consulting across the continent, and most recently worked as a senior investment professional with DOB Equity, which is a Dutch impact fund. Happy to be here, and thank you so much to the INP team.
Thank you, Anne.
Great. Z Digicini. I'm with FSD Africa Investments. I lead our work in venture and early stage funds. Prior to joining FSD Africa Investments, really to lead the Nyala facility that is has been established to support emerging managers. I spent 3 years at the Collaborative for Frontier Finance, who's done fantastic work in really building the ecosystem alongside other ecosystem builders. And then prior to that, I tried to raise a fund. So I think I bring a perspective, and I have many gray hairs from the various sides of the ecosystem. So yeah, and I just, maybe to start off, really want to congratulate the INP team. This is a fantastic report, and I think it really captures all the learnings over the last 10 years, and really it's wonderful to see that backed with actual statistics that we can actually have proper discussions around this, and really looking forward to the discussion today. So thank you for this opportunity.
Thank you, Z. So maybe to start, Aissatou, if you can go to the next slide. When we were doing the report, the study, many people were asking, why do you want to spend so much time analyzing the ecosystem right now? And truly, it's because we stand at the junction of GPs and LPs, and sharing the reality of both of these worlds, this perspective. We wanted to express how much we empathize with GPs, as well as understand the LPs' requirements. INP started investing 22 years ago. I think we're pioneers in the impact investing space in Africa. It led us to think 10 years ago that the missing middle was going maybe way beyond that what we were initially expecting. And we really wanted to to bolster the innovation, the entrepreneurship, really on the ground with locally domiciled funds. And so we created IPDev. We will talk a bit about IPDev today. And then we've been advising and managing funds of funds ever since then, most notoriously the Mastercard Foundation Africa Growth Fund, for which we've been a fund advisor, and the FASA Fund, for which we will be fund manager starting this year. All this activity, all this knowledge led us to launch ecosystem activities, because this positioning at the crossroads allows, I guess, to advocate from a place of experience. So that was really the goal, to benefit from all these experiences, to showcase basically what our ecosystem has been doing. So it leads us to the project with the Argyges Foundation. Aissatou, I'm letting you follow.
Thank you, Marianne. So this report is one of the first part of a four-pronged advocacy project that we have embarked on with the Argyges Foundation. And we would like to thank them for their long-term partnership with INP and for sponsoring this research project. So we have embarked on this advocacy project for the SME investing industry, which will include publications, this report being the first of the sort, community building, and upcoming masterclasses. So first, our next three courses of action would be to build a community of first-time LPs that are seeking to allocate more capital to African SMEs, and that would soon be launched. Then carry on in-depth SME fund case studies, and then finally incorporate all the feedbacks that we will receive throughout this year from the industry, and publish a more comprehensive and data-driven report, updated version of this report by the end of this year or early next year. And to that effect, we will soon share a wide feedback survey to make sure that we capture all the reaction from the ecosystem over the next upcoming months. So this report is divided into two main sections, as you will notice. The first part will analyze the fundraising landscape from SMEs funds that are investing over the past 30 years, and draw really the portrait of the key different players from the different type of GPs. And we have studied many types of funds, the early stage funds, mostly below $20 million of asset under management, the gross SME funds between 20 and 100 million that are investing in medium-sized gross SMEs, and also the SME debt fund, which are investing debt into fund sizes around 10 to 80 million. Alongside the GPs, we have also showed the portrait of the different type of LPs that are investing in these funds, the development finance institutions, the African private and sovereign capital, and the catalytic capital funders. And finally, the second part of this report goes in depth into the structural challenges of raising and sustaining SME funds, from looking at their fundraising dynamics, their liquidity and return profile, the domiciliation, the currency risks, the race to retain and train talent, as well as some of the ingenious solutions that GPs are finding to circumvent these challenges and ensure success for their fundraising. And to do so, we have assessed the fundraising landscape for SME funds, incorporated the insights from key ecosystem players with 37 interviews that we have conducted with a wide range of actors. We have looked in depth at a wide sample of 135 funds in Africa and documented their key learnings, and in order to provide up-to-date data and lessons from these LPs and the GPs on how to design and raise SME funds. This report is just a first step, and its conclusion, as I mentioned, needs to be challenged and refined with an expanded sample of data. And in response to more direct input from GPs and LPs. So as I mentioned, a more enriched version will be published that will incorporate the feedback from the industry. And I'll pass it to
Thank you, Aissatou. So we could talk about a lot. We made that report boring with 142 pages. It's very long, but we decided that for today, maybe 3 key findings would be the most interesting to debate with Z and Anne. The first one would be the long road to fundraising and how fund managers succeed. The second one would be about data, which suggests that performance of the SME funds is improving. And the third one will be about the LPs' perception and standards that can be challenged by realities. And that's what we've been seeing when we did the report. So from your first read of the report, maybe first question for Z and Anne. What were your initial reactions? What section you think interested you the most? Or maybe which part do you think is the most useful to the SME investing industry, whether for your fellow LPs or your fellow GPs?
So what was really stood out for me, I think the whole report and the way you really backed up the report with actual statistics was really interesting. And it really confirmed a lot of what we have experienced in managing or working in the ecosystem within this space. I think what really stood out for me the most was really around previous experience. And this idea that managers have to have come from traditional investment, private equity type experience to be able to work in this space. And to actually see those results of actually fund managers who are operators, who come from adjacent areas, have actually outperformed those who come from traditional areas, which to me was really comforting. And I think really supports what we're trying to do in this sector. We need a lot of innovation. There's a reason why more traditional funds haven't invested in the sector, because it's very challenging. So I think with people who come from who have experience outside of traditional fund management, typically come with innovative ideas, and yeah, you're seeing that happening in the performance, which to me was a great step to see.
Yeah, that's super interesting. I think the report covers quite a lot the type of profiles that we've been seeing, that successful fund managers, successfully fundraising, and this would, I think, blow the minds of a few LPs, because we've been used to a very precise and normalized ways of doing things. And I guess, Anne, you might have found interesting data and insight as well in the report.
Yeah, so I'll start off by saying that, I mean, the report truly is exceptional, and I like that it really, I think, challenges a lot of hypotheses that both LPs and GPs have about what it means to be both an SME fund manager as well as a first-time or emerging fund manager. Two things stood out for me. One, pleasantly surprised around the gender angle, so that, I think it's 80% of emerging fund managers are women. And I think if you look at the data in isolation, it can be a bit discouraging, but then you see that, for example, in early stage funds, half of the fund managers are women, and even in debt SME funds, I think it's close to 50% are, led by mixed, female and men teams. And so I think that truly is encouraging. And then the second thing that, to use your words, Marianne, really would blow the minds of LPs is that emerging fund managers perform higher and perform better than experienced fund managers. And you see that in higher MOIC and in TVPI data as well. And so really excited to dig a bit deeper and understand why. But those were two, I think, really exceptional pieces of data that stood out for me.
Yeah, I guess we will go back about performance when we will talk about key findings number 2. So I guess maybe we can start by the long road to fundraising. So to be clear, it might not come as a surprise to anyone in the room, and especially all the GPs trying to fundraise. But yet, from the review of our global sample, we were amazed to see that so many first-time fund managers failed to achieve first closing. It was 5%. And then only 27% reached their viable or target fund size. And this data point includes a survivor bias. So the actual percentage, we are pretty much convinced of it, might be much lower. We also found out from our sample that it takes on average 25 months for emerging fund manager to achieve their first closing. And the max that we have observed is 48 months for a particularly resilient fund manager. So Anne, maybe first question for you as a GP. We know that you had the strategy to fundraise, a very efficient and pragmatic one. You took a very pragmatic approach. Can you tell us more about your fundraising journey in terms of finding an anchor investor, in terms of sustaining the number of months to achieve a closing and covering all the costs, because we know that's really the pitfall. And maybe a second question directly with the first one, what would be your advice to fellow fund managers in this regard?
Okay, so I'll start off by a caveat that we are still on the fundraising journey. So I think that's important, but happy to share our lessons, bumps along the road, potholes along the road, depending on where you're from. I think we started off by first asking ourselves, what is the minimum viable fund size to achieve the strategy that we want to achieve? And the math came to about 20 million or so. We tested this in the market and I think decided that a nice round number is about 30 million, which I think allows you both to deploy, get enough fees, and attract LPs who have certain minimum investment requirements on their end. And so we confidently went into the market with a $30 million fund size. We were in advanced conversations with a potential anchor investor, and unfortunately that fell off. And so we had to go back to the drawing board and ask ourselves, okay, we don't have $30 million. We were fortunate enough to have a $3 million commitment from an angel investor, a high net worth individual, which initially we thought, well, that's only 10% of the fund. But then we, I think, really reframed our thinking to ask ourselves, what can we do with $3 million? Around the same time, a lot of potential LPs were asking us, what's your track record? What have you done? And so we made a difficult decision to say, look, let's pause on fundraising and instead focus on deploying what we have, which is $3 million. And so that's what we've done. We put together an investment committee, all of the investment policies and the structures to be able to invest. And we've now have now identified and have signed with 2 companies to invest in them, and are currently in the closing processes of that. And so I think then it's not easy, it's challenging. $3 million isn't enough to pay management fees. And so you have to, I think, really be creative on other ways in which to keep the lights on and have, a small but lean team. I think for us, it was through our relationships, one, doing quite a bit of consulting work, 2, also able to access a working capital facility, some debt that I think has really helped us in the journey to be able to deploy the 3 million and I think really develop the track record that a lot of potential LPs were asking us about. And so I think to your next question, Marianne, around the advice, I think one is it's not easy. And so I think you have to be fairly resilient and have a thick skin to be able to do this, particularly investing in SMEs. start with what you have. Don't let the perfect get in the way of the good. And so if you don't have 30 million, but you have 1 million, then start working on investing that. Be flexible with your strategy as you go. So be very clear what's the core thesis. But if you say, look, I wanted to do $2 million deals, but you can't do $2 million deals with 2 million, then maybe you should start off with $100,000 or $200,000 deals. Find a community as well that builds you. So I'm fortunate to be a part of a number of communities like, CFF, the Collaborative for Frontier Financing, AWI, which is the Advancing Women in Investing. And I found that these have also really helped along the journey with fellow emerging fund managers. And lastly, don't get caught up in the FOMO or don't get swayed by the crowd. I think it's easy to see everyone flying out for conferences and releasing press releases about all the amazing things that they've done, but I think really stay true and stay authentic to who you are.
That's interesting how you tick a lot of the boxes that we've looked at when we did the study. So I guess, Aissatou, you can move to the next slide. I think there was a question from Diana asking, can you share some of the innovation in fundraising you are referring to? Well, you have, I would say, a snapshot of a few on this slide. Basically, what we've seen in terms of numbers is that the people that do raise progressively to build track record and credibility managed to reach first close much quicker than others. They usually partner with a sponsor to access resources and funding. So that's also something that is really driving change in terms of do you achieve or not your first close. And sometimes they team up with other GPs to straighten their case. And I guess a lot of the debates that you can have in the industry are regarding solo GPs versus co-GPs. It was interesting to see that solo GPs are actually efficient as well, performing as well, and are not entirely always to be seen or to be perceived as a risk. So regarding that, Z, there is a question from the chat as well, asking what kind of non-traditional background did this successful fund manager come from? I guess it was in your introduction that you were saying that. And also, how did they convince LPs to invest with limited track record?
So yeah, I think what's a really useful skill to have as a SME fund manager is really operational experience. So this space needs a lot of hand holding. A lot of the businesses that the managers are working with are really helping formalize them and to eventually grow them. So that operating skill is really important. And then yeah, understanding financial markets, financial investing experience from an adjacent market, be it banking, be it more traditional asset management, can also work in this sector. But I think coming to the sort of the idea of partnership and building a team, when we assessing these managers, we're looking for a strategy that's suitable to the market, that's really trying to address a challenge that's been identified in the market by that team. Then we're looking for a team who can execute on that. And then finally, yeah, and a team that sort of stays together. And I think from a team perspective, one can, a solo GP can build a successful team around them. And we can help with capacity strengthening to get more junior team members to where they need to be. But I do really think from our perspective, an ideal situation is where you have one team member or senior team member who has the operating experience linked to someone who has some kind of investing experience. But yeah, I think as LPs in the sector, and specifically in this part of the market, we really need to be more open-minded. What we're also seeing is a lot of managers come from angel investing. they've got a lot of experience of successfully doing angel investing, and then are carrying that track record through to actually setting up funds. So I think there are many ways to skin the cat, and really, I think having stats like this helps us move away from that traditional mindset.
Yeah, so I guess also because I'm seeing the time running out, I think what you said is related a lot to performance. And I see a lot of questions in the chat regarding performance, regarding what we said in the introduction, that emerging fund manager are actually performing better than experienced one. This one is having people react a lot. So maybe Aissatou, I think we can move on to key finding 2.
Oh, thank you, Marianne. Yes, so the second part of our reports, and here mentioned with the key finding 2, is really goes into the details of some of the structural challenges that are encountered by the small and mid-size SME funds, and notably with an analysis of a sample of SME fund return. And of note, when we were doing this analysis from the sample that we had, we noticed that one of the latest analysis of SME fund return was a study that was done in 2019 by Shell, Omnidia, and Deloitte, that was based on fund vintages prior to 2015 and gathering data from DFI portfolio. And that data showed that the average fund performance of SME fund was quite negative, and that on average, SME fund took 14 years to achieve a positive TVPI. And that was corroborated at the time by feedback from DFIs on their SME fund portfolio. Our analysis has focused on funds with vintages post 2015. And it showed that with the same average year, age, performance is improving quite significantly, and that SME funds can reach positive TVPI on an average of around 7 years. So one question from Z here: were you surprised by some of this data that we uncovered on the SME fund return, which suggests that performance is actually improving? And is it consistent or not with what you've seen in the market?
No, I actually wasn't surprised by the statistic. I think there are a lot of reasons why we're seeing an improved performance in a lot of these SME funds, and you listing them out there as well. But I think, one needs to look at maybe that traditional, or that study that was done by Midyar and Shell Foundation on a lot of the DFI portfolios. Potentially those portfolios, we're trying to adapt a 2 and 20 model to this type of financing. So hence maybe that's a good reason why we've seen an improvement in performance of funds. And because now, people are using open-ended vehicles, etc. And I think that's making a huge difference. I also think that there's a lot more concessionary funding in the market available to support managers, be it from capacity support to setup costs, etc. So I think that's helped in strengthening these managers to do their jobs better. Then I think we can never discount the peer learning that's happened in the industry over the last 5 to 7 years. We've seen innovators really try innovative models with self-liquidating instruments, etc. And that learning is being shared across the market. So a new manager doesn't have to go and experiment. They can really pick up from where others have sort of built the industry and learn from there. So I think those various approaches from structuring deals, investment readiness, also the way that from a setup perspective, a lot of the managers are doing the investment readiness work using grant funding. So by the time funds come into their portfolio, they are sort of better suited to perform. So I think there are a number of contributing factors, and I think we should see this only improve over time as we really prove out the credibility of these different models in approaching this space.
Thank you, Z. And Anne, you have had a long experience investing yourself, and clearly you have incorporated those learning into setting up the launch of Sayuni. What are some of these key elements that you wanted to incorporate in your fund design in order to potentially improve LP returns?
Yeah, so we thought about, when I say we, it's my partner Stanley and I. So we thought about increasing LP returns in two ways. I think one is really around upside, increasing upside. And then the second way is really around managing costs and thinking about structuring. And for us, increasing upside is really around providing debt alongside mezzanine financing and being able to see some upside, particularly with revenue share or profit share mechanisms. And so this is something that we are structuring and doing now. And not only does it help protect your downside, but it also, I think, allows you to grow with the SME. And so we do this, and there's other SME funds like Alpha Rain in South Africa. That's a private credit fund that's doing this as well. And then second, really in reducing our costs and thinking about models like Z mentioned, open-ended funds. And so, we've started off by creating an SPV as a temporary solution, but, following that, the setup will be an open-ended capital vehicle. And we're seeing a lot of innovation in the market to, I think, really set up different types of funds. So for example, Kuwaya Lead Capital that's setting up the first Sharia compliant fund in West Africa. And similarly, I think a lot of funds really see that de-risking the investments that they make really helps to then increase upside. So, technical assistance programs and the advisory work similar to what Z mentioned. And so, different funds in the market like Shiamo Gender Lens Fund or She Equity, they also provide the technical assistance and advisory work, which helps to increase the quality of the pipeline and then also provide technical assistance. And I think a combination of all of these efforts, I wouldn't say do it all, but just find, one or two things that work really well for you to be able to increase your upside.
Thank you, Anne. And one question that we had in the chat coming from Stefan was on some of the reason why I guess emerging fund managers are performing better than the existing one. And I think, Z, you have touched a bit on that. Any particular feedback on that question as well from you, Anne?
Yeah, I think for a lot of us emerging fund managers, we're really building the plane as we fly it, right? And so we are forced to be very creative and innovative in the types of ways that we do deals. And so, for example, when you're thinking about, due diligence and how you take risk in investing in an SME, you're not just doing a financial, commercial, and legal due diligence. Like we look for people who know the entrepreneur and who've known them for 5 or 10 years to be able to say, look, if I'm investing in Anne, for example, like who is she? Where does she go to, where did she go to school? Who are her friends from university? Where does she go to church? What type of a person is she? And so we do a very informal but thorough integrity due diligence on the entrepreneur because we know we can't afford to make any mistakes. And so I think this extra level of diligence and being forced to be creative is one anecdotal way in which this could then potentially increase our returns.
And maybe just to add to that, I think what's also interesting in the industry that we've seen over the last 7-8 years is really this localization of these funds. These funders are based in market, and as Anne said, they know their networks, they understand what's happening. It's not a parachute fund with someone sitting in a Western market making an investment in a market that actually don't understand the intricacies of. So I think we're seeing the benefit of that, and yeah, and I'm sure that is a trend we're going to continue to see. And we're even seeing it from a DFI perspective. They may not be investing in this space, but you're seeing the likes of BII bringing out their bold strategy. So I think people are noticing that this trend is actually having an impact on performance.
Thank you so much, Z and Anne, for the very comprehensive response to that question, and I hope that was satisfactory for you, Stefan. As we continued on the report, we had also made several recommendations to investors regarding the need to adapt their assessment criteria in order to back these first-time teams, the emerging teams with sometimes non-traditional backgrounds. And this also comes to the way LPs look at areas like the management fee structure for these early stage, early growth funds, the standard of the 220, the appetite and the understanding for PCVs, the assessment of track record, what does it mean to have a track record, and also the assessment of skin in the game. Z, as you look at these different type of elements, from your perspective, what needs to change in the LP behavior to enable the emerging fund managers continue to raise their fund? And where do you see promise of change from the current LP engagement and collaboration that is currently existing among LPs?
I think what's really interesting is we for this asset class, for this space, we're seeing this continuum of capital being developed. So you've got funders that are coming in, providing the much needed warehousing capital. You've got the anchor funds like ourselves, like yourselves, and then you've got facilities that are scaling, and then you've got the likes of DFIs, etc., the more commercial capital. And I think it's not about really changing the behavior of funders. I think, each funder is in their space. They've got very good reasons why they're investing in that space and trying to reduce their exposure to risks, or reduce risks, etc. Sorry, someone's just coming through. But yeah, so I think it's not really, I think instead of us focusing on trying to change the behavior of the different types of investors, I think we need to look at building out this continuum of capital, building out specifically around the warehousing and the anchoring capital. And I think our biggest challenge is how do we actually scale that kind of support? And I know, IMP, you've been doing this for many years. Our experience in this space as well. A lot of hand-holding is needed to really get the managers to the space where they can scale and can attract that more commercial capital. So yeah, I think the challenge is really how we scale our support and scale the quantum of capital that's coming into the space. But these learnings hold true to the various spaces, and understanding what's suited for that stage of manager, and understanding where they need to get to attract the likes of DFIs and more commercially minded capital.
Thank you, Z. And speaking of that continuum of capital, one important question that we were asking ourselves in this report is the importance of tapping into the pool of African private and sovereign capital, the fund of funds that are being implemented by the sovereign wealth fund that are being created across the continent, or maybe from pension funds, etc. What has been your experience fundraising from these type of institutions, and what do you think we the fund managers need to do more in order to raise interest and capital allocation from these type of capital providers, African capital providers? Anne?
Yeah, I think it's very important for local fund managers to be able to raise from local capital. I think the recent nuclear winter of fundraising and the decline in funding to the continent has shown that. But the reality is that it's really tough. I mean, it's really, really hard, and you have to knock on a lot of doors to be able, just in general, of fundraising. But potentially even more with local capital, right? And local capital is, I'd say, in two roughly two big buckets. I think, the first is, with the retail investors. The reality is you have to be able to build trust with them. And this comes really with, having relationships for a long time. And so if you don't have those relationships, then that door is closed to you. And then the second group of local investors is, local institutional investors, particularly pension funds and pension fund managers. And the uphill battle there is to be able to show not only can you provide returns, but you can also, minimize the downside because they don't want to lose their pensioners' money. And I think the best way to approach this is rather than have individual managers like, Sayuni or Altri or other investors, by themselves approach the local investors, I'd say is really to group together as fund managers and as SME fund managers and present what I'd call a diversified risk strategy for these funds, right? So go to, for example, Kenya Power Pension Fund and say, look, here are 5 funds. You have an emerging SME fund, you have a debt fund, you have a growth fund, and you have a VC fund, and we're all investing in local early stage businesses and just give them, I think, a solution or product that helps to manage their risk, their liquidity profile. Because a lot of times you're competing against tax-free infrastructure bonds or real estate, and then you have to be able to show that, we can do this collectively and not as individual fund managers.
I also think this from a local capital mobilization perspective, and you mentioned Chigaba in your reports, really domestic fund of funds are critical in mobilizing local capital, and the role that catalytic international capital can play in that is really de-risking the space and helping in providing forex to these local fund of funds so that they can get diversification outside of their countries for their pension funds, but also help build the local private equity markets within those markets. So I think fund of funds are critical to really funding this space and mobilizing local capital. In South Africa, we have a very advanced institutional pension fund market that's been investing in this asset class for a number of years. But outside of South Africa, I think we're seeing good progress being made in Ghana, where pension funds have been forced to look at this asset class because of the debt crisis that's happened here. But we're going to see that similar occurrence happen across various markets. So I think it's really important that we help support the development of local fund of funds as well.
Yeah, thank you, Z, for pointing this out, because actually a few questions from the chat are mentioning the question of the African LPs, the local LPs. For example, someone asked how many LPs have invested in solo GPs. It always strikes me as a Western view applied here. And yes, we can actually answer that solo GPs do raise from many LPs. It's only like the institutional foreign LPs that shy away from them. But they raise from individuals, they raise from corporates, from family offices, and so on. And I guess maybe we could talk a bit right now about like all these African LPs and how they sometimes accept as well higher management fees, how it yields results. So maybe Anne, do you want to like react to this question of local capital rather than international foreign capital?
Yeah, I'd be happy to. I don't think it's an either or solution, right? I don't think the answer is either you raise from local capital or from international capital. I think the reality is, a lot of the, SME funds require both, right? So you need, just like an early stage business would, a lot of times you need, family, friends, and fools money to get you started, and a lot of that is going to be, seed capital that's provided by local investors who are willing to take a risk on you as an SME fund manager, just like you're willing to take a risk on an early stage SME. And I think really as along the capital continuum that Z mentioned, a lot of times that we find that the people who are then willing to take risks and write, larger checks are going to be international foundations that can write, $2 to $5 million checks, or fund of funds like the, Moremi Fund or the MasterCard Foundation. And so I don't think it's an either or strategy. I think you need both as the SME fund grows to be able to de-risk and really get the fund off the ground.
And one of the questions that is also coming from the chat is with regard to this comment from recurrent comment from LPs about the fees of 2% that is above 2% that is perceived as too high. And that is true that for the smaller sized fund, the below $50 million fund, we have seen for a fee much more flexibility around management fee from LPs, from the 2.5 to up to the 4% that we have seen across the funds that we have looked into. And sometimes with a 4% management fee that can be perceived as high, but which is quite adequate for the size of the fund. The SME funds usually compensated by having higher recycling effect on their investments. Do you have a particular reaction on that point of the what is the adequate management fee from your perspective, Anne?
Yeah, I mean it's a tricky one, and there are usually two camps to this. I think there's one camp of fund managers that says, look, you need to keep the lights on, and the best way to keep the lights on is by increasing your management fee to say 4%. And then there's another camp that says yes, but then you reduce the amount of capital you have to invest, and then this risks your gross and net and IRRs. I think the reality is, it depends. I don't believe the 2 and 20 model, copy pasted into this market is appropriate. And so you need to find the right balance that allows you to both, have a high quality team, support the entrepreneurs and the SMEs that you invest in, while at the same time, not compromising your IRRs. I think for us, for example, what we found is that 3% for Sayuni is a good number. So we're targeting, 3% management fees, and then supplementing that with some consulting work to help keep the lights on. And it's not ideal, but I think we've found a solution that works for us, and hopefully, other SME funds are doing the same for themselves.
Aissatou, there is a question in the chat that you could actually answer to. Someone asked, have local LPs investing in local funds shown a preference for domestic currency investment over hard currency investment, given the potential impact of currency depreciation on returns of funds?
Sure. So yes, exactly. That's what we have seen in the market from these local investors, whether they be commercial capitals or the banks, the insurance companies, or more institutional type of capital, like the sovereign wealth fund, because they do understand the realities of the market. Their assets themselves are usually domiciled in country, so in local currency. They do show an appetite for investing in this fund in the local currency because they understand the risk profile in this country and investing in these SMEs. So yes, we have seen that African LPs, commercial or institutional, usually have an appetite for investing in local currencies in the funds that are domiciled locally. Has that been your experience as well, Anne or Z?
Yeah, I think from a local currency perspective, I think it's very much needed for SME funds, and yeah, the most logical investor would be local pension funds, and we're seeing that support coming from local pension funds or local institutional investors. So I think they play an important role, and specifically if they're going to be when managers are offering debt type instruments, local currency is critical. Yeah, so yeah, I think we really need to look at, and from a fund manager perspective, as you raise your funds, I think really look to see how you can engage local funds, and typically that means being locally domiciled. So and then, but speaking to Anne's point, how do you balance that with the international capital that's available for this space? But I think more and more we moving to actually look and support managers who have strategies that are really looking to raise locally rather than relying on international capital.
We have only 5 minutes remaining for the webinars, so maybe one last question from Aissatou and I, and then we will take a few questions from the chat as well that have not been answered yet. And of course, as we did the report, our main question is, where do you think we should go more in depth for the reviewed version of the report? Or what critical part of the industry analysis has been left out from your perspective that we should focus on?
Yeah, from our perspective, yeah, we wanting to do some of this work with you is really looking at from a value creation perspective, what strategies are being used by these managers in creating value within their portfolios, what value creation strategies are appropriate for the different types of capital that's provided. So I think that would be, for us, would be an interesting area to go in more depth about.
Noted, Anne?
Yeah, I think I've said this before, but this truly is an excellent report. And someone I respect a lot, once said that as fund managers, you're in the business of raising capital. And initially I disagreed, and to some extent I still do, but hopefully I think answering additional questions around one, how can we actually better mobilize, local capital? What are some of the other solutions that can be done to prevent first-time fund managers from, from falling off? Thinking about, either warehouse financing or creating an early stage investment platform for first-time fund managers, and thinking through what solutions could work from, even from other emerging markets, I think would be helpful to really help fund managers go from the business of raising capital to going into the business of deploying capital and returning capital to LPs.
We have our roadmap, I guess. Thank you. So we're looking at the chat, a lot of questions regarding early stage funds. And I guess I'm going to ask that to our LP in session. Why aren't LPs investing more in early stage funds, even though you, Z, are investing a lot in them?
Yeah, I think it comes down to limited data, which this report is really trying to address, a limited understanding of the models. And then sort of the bigger, more commercial LPs, they have risk limits, they have returns that they're targeting that potentially these funds aren't quite ready to meet. But as I said earlier, I think there really is an opportunity to look at how we use the catalytic capital and scale the catalytic capital that is available. And we've seen it grow significantly over the last few years. And then also, really work towards this local capital mobilization and what's required to bring the local institutional capital into these funds. Yeah, so there's a lot of work in progress, but I think we've made good progress over the last 8 years, and I think it can only get better from here, to be honest.
Sorry. So, yes, we continue to receive more questions on the chat. So we have selected maybe 2 questions to end this webinar. And one of the questions being, do we have too many GPs competing for not enough LPs? Anne?
I mean, I'm pretty biased, and so I don't think you have too many GPs. I think the reality is, and this data is really shown really well in the report, the SME financing gap is $90 billion. And currently, funds that are in the market fundraising, you add everything up, it comes to, I think less than $10 billion, right? And so there's, a 10 to 15x gap if you look at the amount that funds are fundraising versus the SME financing gap. I think that said, it's tough to have very many subscale funds in the market that, likely with subscale economics, we've seen, recent merging of funds. So for example, ATG Samata, and I wouldn't be surprised if we see, similar consolidation of funds, just because the economics are better and it makes sense. But I think you really have to make sure you're aligned on the thesis, are you aligned on your values as entrepreneurs, or as SME fund managers, because it is a big decision to make, but I wouldn't be surprised to see a movement in that direction.
Sure. So that is one of the areas that we have started to see in the market, and we'll actually touch on that in the report. But yes, we do believe that more consolidation could happen from these fund managers to continue to raise more efficiently and from LPs existing but also new. And we believe that there is more a potential for more LPs to enter the segment, and that is one of the points that we would try to work on, address through the rest of this advocacy project with Argidus, the next step of which being to try to build a community of first-time LPs, investors that are looking to allocate more capital into African SME funds. So try to find them, try to organize them into a community, share insights, share pipeline. That's the next step for us, in addition to the second section of this report.
And I think time's up. I want to thank you, Z, and I guess this is really the first step. This conversation, I think, is only starting, and we need everyone. I mean, you, of course, but also everyone that joined today to be part of this initiative. To this end, you can give us feedback on the report. Julie and Hugues will put the link in the chat. It is very, very